Hi there, this is Focus on GRA, and I'm your host, Carolita Edwards. This week we focus on capital gains tax, property tax, and a tax specialist will join us to provide information on corporation tax. Focus on GRA begins now.
The Guyana Revenue Authority is reminding taxpayers signing up for e-services to ensure that they complete their registration correctly. Please be reminded that your taxpayer identification number should be entered in the username row. Additionally, no dashes or spaces should be used when inputting the tax identification number. Remember, registering for e-services allow you to submit your return online at a time convenient to you. Don't delay. Sign up for e-services today.
If you are planning on disposing an asset, it is important that you understand that you may be required to pay capital gains tax. Let's learn more.
When disposing of an asset, whether movable or removable, you will be required to pay capital gains tax to the Guyana Revenue Authority if you make a gain on disposal. This category of tax is administered under the Capital Gains Tax Act, Chapter 8120. But what exactly is capital gains tax and how is it charged? Ms. Melissa Romeo, Assistant Commissioner, tells us more.
Capital gains tax arises from computing the tax on a gain, and such gain arises from change of ownership of a property, meaning transferring it from themselves to someone else or selling it to someone else. So the tax arises from the gain incurred from that transaction.
Therefore, if an individual acquired a property in the year 2020 for $10 million and they are now disposing of it for $15 million, the difference of $5 million will be the gain on the transaction. This amount will attract capital gains tax at the rate of 20% in keeping with Section 12 of the Capital Gains Tax Act. It therefore means that the sum of $1 million will have to be paid as capital gains tax. What must also be noted is that there can also be a loss from the disposal of an asset. A loss will arise where an asset is disposed of for less than the cost for which it was acquired. There are also instances where capital gains tax will not be applicable. Ms. Romeo highlights some of these instances.
There are certain provisions by law where capital gains tax is not applicable. And one of the main one, I must say, is where the property or where the person owns the property for over 25 years. So that means that if you bought a property since 1996 in your name, mind you, and you owns that property since then and you come to dispose of it now, by any means it doesn't attract any capital gains tax because we recognize that you would have owned it for over 25 years. We also have those cases or those transactions where persons may own a property for just a couple of years, but they're coming to transfer it. For example, if they come to transfer it to their spouse or any other person, they come to transfer it and that property will be remaining jointly with that person. No capital gains tax is attracted there. Also, if that person is transferring the property to someone and they are remaining with life interest in that property, you have no capital gains tax arising out of that transaction. You have cases where recently, a couple of years ago, the law was revised to include if someone is disposing of their private property and they are about to acquire another one within the same period or the same year of assessment, no capital gains tax would be attracted to the transaction for the sale, providing that the person provides some kind of justification to us that yes, indeed, they're going to purchase another property using the same funds from that transaction. You also have the case where the capital gains ceiling is $500,000. When I say ceiling, I mean, for example, if you acquired the acquisition cost for this property, this land is $1 million, and you're disposing it at a value of 1.5, you have a difference in gain of 500,000. So because that gain is 500,000, and based on the provision outlined in the legislation, if the gain does not surpass 500,000, you should not attract it. It would not attract any tax.
It is also important to note that the $500,000 is a ceiling and not a deduction or an allowance, and as such, once the gain exceeds $500,000, the 20% must be applied to the entire amount. The due date for the payment and submission of the capital gains return is April 30th.
The Guyana Revenue Authority has noticed that there are many misconceptions about property tax. In this feature, you will learn what is property tax and who must file this category of return.
The Guyana Revenue Authority finds it necessary to provide pertinent information to taxpayers about their obligations. One such obligation is the submission and payment of property tax. To put simply, property tax is a tax paid on property owned by a person. Property, as used in relation to the Property Tax Act, refers to the following: all property movable or immovable, rights of any kind, and effects of any kind, situated or having their seat in Guyana or elsewhere, the proceeds of sale thereof, and any money or investment for the time being representing them. However, the term net property refers to the amount by which the total value of the property owned by any person at the end of the year exceeds the total value of all debts owned by him at that time. That is, the difference between assets and liabilities. What should be noted is that any person, resident or non-resident, whose net property situated in Guyana exceeds $40 million is required to file a property tax return and pay property tax. This legislation took effect from the year of income 2019, year of assessment 2020. Therefore, if your net property is less than $40 million, you are not required to file a property tax return or pay property tax. The submission of property tax and payment of property tax does not apply to the President of Guyana, any local authority, approved charitable organization, any statutory or registered building or friendly society, Transport and Harbors Department, the Central Housing and Planning Authority, just to name a few. Section 6 of the Property Tax Act, Chapter 80121, outlines all those who are exempt from this category of tax. An individual paying property tax is subject to the following rates. On the first $40 million of net property, no tax is applicable. For every dollar of the next $20 million, 0.5%, and for every dollar of the remainder of net property, 0.75%. When submitting a property tax return, the individual must ensure it contains the values of all of their assets and liabilities. Examples of assets are land and building, motor vehicle, household furniture, tools used in trade, shares held in a company, etc. Examples of liabilities are mortgage, loan, overdraft.
We want the best facilities that this country could ever see, the best infrastructure and public utility, the best education for children in this country, the best health services and public security. But if we want to see such development in every community, then we must be fair and pay we full share of taxes and duty. Want proper bridges and coca, pay your tax. Better roads and safer, pay your tax. Better electric power, pay your tax. Clear potable water, pay your tax. Better schools and teacher, pay your tax. Better nurses and doctor, pay your tax. Better police and soldier, pay your tax. For a better Guyana, pay your tax.
Welcome to Your Question in Focus. Joining me today is tax specialist Susan Watson, and she will be providing us with information in relation to corporation tax. Ms. Watson, we are happy to have you on the program today. The first question I would like you to answer is, what is corporation tax?
Corporation tax is a tax imposed on net income of the company. Section 6.1 of the Corporation Tax Act, Chapter 8103, states that corporation tax shall be charged for each year of assessment upon the chargeable profits of the company arising in the year preceding the year of assessment.
Ms. Watson, we all know that a company can be classified as either commercial or non-commercial. But what is the difference between the two?
A commercial company means a company where at least 75% of the gross income is derived from trading in goods not manufactured by it, and it includes the following: any commission agency, any communication company, anybody corporate, licensed or otherwise authorized by law to carry on banking business in Guyana. Any company carrying on in Guyana insurance business other than long-term insurance business. On the other hand, a non-commercial company is one that is engaged in manufacturing. An example of a non-commercial company is a garment factory. In this instance, the gross income is derived from manufacturing. In addition, there are also companies that are involved in both non-commercial and commercial activities.
And finally, can you tell us about the tax rate that is applicable to a commercial and a non-commercial company?
The rate of tax that commercial and non-commercial companies pay to the Guyana Revenue Authority are as follows. Commercial companies pay 25% of the chargeable profits. Non-commercial companies pay 40% of the chargeable profits. However, in cases where companies are involved in both commercial and non-commercial activities, the dual rate of 25% and 40% will apply. I would also like to mention that companies are required to pay quarterly installments. The due dates are March 15, June 15, September 15, and December 15. Companies must also submit corporation tax return and an audited financial statement on or before April 30th each year.
For more information on corporation tax, you can make contact with our Tax Advisory Services section on 227-6060 extension 8000. And that's all for this week's Focus on GRA. Before I go, let me remind you to visit our website www.gra.gov.gy for more information. You can also send us an email at grapublicrelations@gmail.com. Thank you for watching. I am Carmelita Edwards.